Well, I certainly don't have to tell those of you with 401ks or portfolios, it's been a rough several months. But just like when football teams, they hold up four fingers, hey, finish that fourth quarter strong. There are some strategies you need to consider to finish your fourth quarter in the black. Joining us this morning on Good Day Alabama is a Good Day Alabama contributor, Marshall Clay with the Welch Group. Good to see you this morning.
Hey, good to see you.
We were just talking before the break about rebalancing. And I don't know if everybody who has a portfolio or a 401k understands that and the strategies behind that. First of all, talk about what rebalancing means.
Yeah, so essentially what you're doing is you've got a portfolio of either individual companies, mutual funds, ETFs, both stocks and bond side. And so the key is throughout the year, you're going to see these varying assets. Some are going to move up, some are going to move down, some kind of stay, right where they were at the beginning of the year. Mm-hmm. And the key is if you believe in those assets longer term, the key is to constantly look for opportunities to take profits off the ones that have done really, really well and rebalance those towards ones that haven't done so well. So what you've seen do well so far this year is the value-oriented individual companies and mutual funds, the ones that are in really high-quality companies that are making money, that can pass on price increases to their consumers. The ones that aren't doing well are the high-flying speculative assets like tech companies, the bonds that are a lot more, or that involve a lot more risk in nature. Those have not done well. So rebalancing away from the winners and to the losers is really the key.
So let's just say, for instance, if you look in your portfolio and you got one area that's invested in energy, which is doing pretty well now. Take some percentage of that, put it in ones that aren't doing so well, and that's going to help you.
Correct. You're not abandoning those positions, but you're just shaving off some profits off the winners and redeploying those profits towards the ones that haven't done as well. Because the market typically doesn't move up in lockstep where everything moves up in unison. There's always going to be some losers that are out there, really, no matter if the market is going up as a whole or not. So there's always going to be some losers out there, but they typically have their day in the sun at some point, so you want to be buying them when they're on the low.
All right, meanwhile, if some of you out there, when the market really started to go down, maybe you started selling stuff and you made some money, and you're saying, well, I'm going to have a tax burden because of that. There's a way to offset that.
Absolutely, and we're doing this a lot for clients right now that have those individual losses. We're going in and we're taking losses off individual stock positions, and that allows us to offset those gains that you talked about, whether they were realized this year or maybe in previous years. If there's no realized capital gains to offset, you can actually deduct some of those losses against your taxes. So tax loss harvesting is a very important tactical maneuver that you can execute towards the end of this calendar year to save yourself some money on taxes.
So again, yeah, you're selling a position, you're selling it at a loss in order to write that off. Now on the list there was Roth Conversions, and so we're going to dive deeper into that next time because that's a very complex issue as well. But just on the surface, tell folks what we're going to be talking about next time.
Yeah, so the government limits how much that you can put into a Roth IRA on an ongoing basis, and so the Roth conversion is a mechanism in which you can voluntarily pay taxes sooner than you otherwise would to get money out of a pre-tax IRA, which ultimately is going to be subject to required minimum distributions when you get older. So this Roth conversion strategy allows you to get money out of that pre-tax IRA, move it to a Roth IRA, a more substantial portion into that Roth IRA, which grows tax-free and is not subject to those RMDs. So we're going to talk in more detail about that next week because that's a very important thing that people need to know about. They could take advantage of.
So hopefully we'll help you understand that a little bit better next time. Marshall Clay, Good Day Alabama contributor. We do appreciate